Do you know how much money you need to have saved to retire? For like most people, you probably don't. But in today's video, I'm going to share with you 2 simple things you need to know so that you can answer that question of having enough money saved for retirement. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So how much money do you need in your portfolio so that you can retire? It's a hugely important question because so much of our financial lives is dedicated towards preparing for that moment of financial independence. The hard thing is there's so many variables that impact that. Between inflation, the stock market, your expenses, Medicare, Social Security, all of these things impact how much you need to have saved for retirement. So what do we do? When there's all these different things that impact it, in today's video, I'm going to simplify that down to 2 things. If you can answer these 2 things, then you'll have everything you need to know to understand how much you need to have to retire. So as you're listening to this, and we're starting to unpack how much money do you need to have saved to retire, I want to ask you, how much do you think you need to have saved to retire? Do you have an answer? If so, comment below because I'd love to see what everyone has to say. Now, what we're going to do is we're going to understand and explore how these 2 different questions, the answer to these 2 different questions will give you everything you need to know to understand if you can retire. Big disclaimer as we go through this, the best way to approach this is through software. The best modeling approach to understanding your financial needs is through software. There are a lot of variables, but what I want to do is start with these 2 things to show you. If you don't have that software, if you haven't done that before, if you're not working with a financial advisor, how can you get very close with the answer to 2 basic questions? So what are those 2 basic questions? Well, number 1 is what are your retirement expenses? And number 2 is how much of those expenses need to be covered by your portfolio. So it seems simple enough, but I'm going to show you how that gives you everything you need to know to understand when you can retire. So let's start with number 1. Now, it's not always easy to know what are my expenses going to be in retirement. Now, almost nobody knows perfectly exactly what their retirement expenses will be, but there's 2 general approaches I've seen people take to get very close. One approach is called the bottom-up approach, and the second is called the top-down approach. Let's explore both in detail. Number 1, the bottom-up approach, that is itemizing every single expense you might have, adding them all up to determine what will your monthly expenses be in retirement. So you literally go through every single line item. What will my mortgage payment be, or my rent payment be, or property taxes? What will groceries be? What will utilities be? How much do I want to spend on travel? What about streaming services? What about vacations? It's literally understanding what are all the expenses I'm going to have to enable me to live the life I want to live, and then assigning a dollar value for each of those expenses. Now, this is the most detailed way to understand what your expenses will be because you're itemizing all of them and assigning a specific dollar amount, but it also is a little bit more time consuming. However, if you do that, you're going to have a pretty accurate idea of what are your monthly expenses going forward into retirement. The second approach is a little bit more simple. It takes less time and it's going to get you generally close enough. It's called the top-down approach. The top-down approach is for those who say, I have no idea what I spend money on, or I just don't track it closely, nor do I have the inclination or the desire to go track that as thoroughly right now. So what's a simpler way to get a ballpark estimate? Well, that's what the top-down approach is. The top-down approach says this. It says, don't add up all of your expenses. Simply start with your take-home income today. So you're going to start with your take-home income, so not your gross income, because with your gross income, you're paying taxes, maybe you have a 401k deferral, maybe you have other deductions. We want to know what's actually hitting your bank account. And what we're going to do is we're going to remove some expenses that will no longer be there in retirement, and we're going to add in some expenses that aren't there today, but will be there in retirement. So for example, maybe your take-home income today is $8,000 per month. Well, does that mean you need $8,000 per month in retirement to maintain your same lifestyle? It could, but what if today you have a mortgage? And what if the principal and interest portion of that mortgage is, let's say, $2,000 per month, and you're on track to have that paid off by retirement? Well, what that tells me is you don't need $8,000 to maintain your current lifestyle, you really need $6,000, because that mortgage will be paid off so you no longer need to pay the bank anymore. Then let's also assume maybe you're saving $1,000 per month for retirement. Well, when you're retired, you no longer need to save for retirement, so we can pull that out of the monthly budget as well. So now we're down to $5,000 per month, and $5,000 per month in retirement, of course adjusted for inflation, $5,000 per month then would give you the same lifestyle that $8,000 per month does today because you're no longer paying the bank and you're no longer saving for retirement. So that might be an example of taking some expenses out that will no longer be there in retirement. then you need to add some back in. Maybe you say, you know what, I want to take more vacations in retirement, so I'm going to add an extra $1,000 per month. Or maybe I'm retiring before 65, so I need to account for medical insurance before Medicare. Because my employer pays it now, Medicare will pay it in the future, but I need to add something in for those gap years before Medicare kicks in. So those are some things that you can do in the top-down approach to say, let's start with a high-level number today, extract the things that won't be there in retirement, add in the things that will be there in retirement that aren't there today, and that's going to give you a general number. So that's where you need to start. Whether it's the bottom-up approach, the top-down approach, start somewhere to understand what's it going to cost you to retire. Let's now assume that you've come up with your number, and just for the sake of using a round number, we say it's $100,000 per year. You need $100,000 per year to retire. Now, if we assume retirement is going to last 30 years, does that mean you need $3 million in your portfolio? $100,000 per year times 30, that's even before accounting for inflation. That might seem like a daunting number to have to save up for. Well, not quite. That's just step number one. Step number one is to determine your expenses. Step number two is to now understand how much of those expenses have to come from your portfolio. And here's why this part is so important. Just because your expenses are $100,000 and another person's expenses in retirement might be $100,000 does not mean you need the same amount of money to retire. The reason for that is everybody has different non-portfolio income sources. What's a non-portfolio income source? Well, it's any income you can count on in retirement that's not drawing from your portfolio. So think Social Security, think pension, think rental income, think part-time work, anything like that, where you're receiving income, but you're not having to draw down your portfolio to create it. So let's look at two different examples here. Let's look at a married couple, and let's look at an individual. And there's no reason that one's married and one's an individual, but just to illustrate the point here, let's understand that both of these sets of examples want to live on $100,000 per year. Do they need the same portfolio value to do that? No. Let's look at this and show why. Let's assume the married couple has the following income sources. One of the spouses has a pension of $16,000 per year. One of the spouses has a Social Security benefit of $36,000 per year, and one of the spouses has a spousal benefit of $18,000 per year. So if you add all that up, $16,000 plus $36,000 plus $18,000, that's $70,000 per year of income. What that means is this couple only needs $30,000 from their portfolio because the remainder is covered by those non-portfolio income sources. So if they need $30,000 per year from their portfolio, if we apply a withdrawal rate of say 5% per year, what that means is if we divide 30,000 by 5%, we get a portfolio value of $600,000. Meaning if this couple had $600,000, if they took 5% per year from that, that would give them the remaining $30,000 that on top of Social Security and pension would give them $100,000 per year throughout retirement. Well, let's look at the other part of this example. We have the single individual, and let's assume the single individual owned a business, didn't really pay a whole lot into Social Security, so didn't have really strong non-portfolio income sources. Let's assume this individual had a Social Security benefit of $1,000 per month, which is $12,000 per year. Well, if that's their only non-portfolio income source, the remaining $88,000 needs to come from their portfolio. If we apply that same withdrawal rate of 5%, to generate $88,000 per year of income from a portfolio would require a portfolio value of $1.76 million. So as you look at this, in both of these examples, the goal was $100,000 per year of income. Again, that's step number one in this example, is what are your retirement expenses going to be? The second part is so crucial because of those expenses, we're now itemizing or we're now understanding how many of them need to come from the portfolio. And in these examples, one person's answer was almost triple that of the other individual because of those non-portfolio income sources. So if you just apply those two specific steps to your situation, you're gonna get very close. Now, why do I say very close? Because there are other variables. As I mentioned at the very beginning, this is a simple example. It's gonna get you very close, but we also can't ignore those other variables. But the thing is, those other variables are kind of like subcategories or subvariables to these two that we mentioned. One is what are your retirement expenses, and two is how much of those expenses will come from your portfolio. Let me explain. Let's start thinking of other variables. What other variables could impact this? Well, taxes. Taxes could impact this. However, I'd argue that's a subcategory or a subvariable of number one. What are your true retirement expenses? Well, really, you should be factoring taxes into that. For example, what if you want to live on $7,000 per month throughout retirement? Well, chances are good you want $7,000 after you've paid taxes. So even if we just apply a 15% effective tax bracket, what that really means is you would need $8,235 per month so that after taxes, now you have the $7,000 per month that you can do with what you want throughout retirement. The hard part with this? Well, Social Security, traditional IRAs, Roth IRAs, brokerage accounts, they're all taxed differently. So it's not as simple as just applying the same exact tax bracket to each of them because they're all going to have different tax treatment, and the tax treatment of Social Security is going to depend upon how much you're pulling out of your IRA and vice versa. So these things are all coordinated, which is why having a good tax strategy in place is crucial, both to understanding how you can minimize taxes, but two, to understanding what will your actual tax rate be so you can get the most accurate expense projection for your retirement goals. Another variable that could impact this is inflation. What inflation really impacts though is it's kind of a subcategory or sub-variable of the second thing we looked at, is how much of your portfolio is needed to meet those retirement expenses. Here's the thing that most people don't understand, or most people don't factor into their plans when they're doing this, is if I take a withdrawal rate, let's use the 4% rule for example, that 4% rule is assuming that I'm adjusting that for inflation each year. So if I'm taking $40,000 per year out of $1 million portfolio, that's 4%. The assumption is that next year I'm going to increase that by inflation, and next year I'm going to increase that by inflation. The following year I'm going to increase that by inflation. So that makes the math pretty simple. If I can start with the right number, inflation adjustments are already built in. Here's the hard part. What if you have a pension, or if you have some other income source that's not rising with inflation? Well, if you have a pension that's covering part of your needs and portfolio that's covering the remainder of your needs, yes, your portfolio needs to increase with inflation, but also it needs to increase by more than that. And when I say your portfolio, I mean your portfolio withdrawals. Because if your pension is staying level, it means more and more of the burden each year to meet your living expenses is coming from your portfolio. So that's where software is really handy, can come into play to really calculate that delta for you, because there's not just a back of the napkin way you can do it, but understanding that is very important. Marital status can impact this, believe it or not. And not just because if you're married, maybe one spouse spends more than the other, but because of your tax brackets. I used the example before of let's look at a married couple that wants to live on $100,000 per year. Let's look at a single individual that wants to live on $100,000 per year. Well, that single individual, based upon today's tax brackets, they would be at the top of the 22% tax bracket. The married couple, however, they'd be about the middle of the 12% tax bracket. Why the difference? Well, the tax thresholds are higher for married filing jointly than they are for single, and on top of that, the standard deduction is double. So when you're looking at this, even someone with the same desired expenses, even someone with the same desired non-portfolio income sources, if their married status or if their tax filing status is different, that could actually impact your true expenses. Then there's other variables, health insurance costs, long-term need costs. All these things need to be factored in, and they're not going to be exactly linear throughout retirement. Lifestyle costs as well, that's a huge factor in this. When we're trying to factor retirement expenses, those aren't just linear throughout retirement. You have what are called your go-go years at the beginning of retirement, when you're going to be more active, you're probably going to travel more, you're probably going to do more. That might cost a lot more. Then you have your slow-go years. So after go-go comes your slow-go years, where you're still doing things, but you're not taking the same trips you once took. You're not going out as much as you used to go out. Life costs a little bit more. Then you have your no-go years towards the end of your life, where maybe healthcare expenses become much more of a burden and become much higher. So as you're factoring all this in, we have to understand how will living expenses ebb and flow over time. So how can we have a strategy that's designed to capture that? So as you can see, there are a lot of variables that impact this calculation. However, if you just know those two variables, what are your retirement expenses and how much of those retirement expenses need to come from your portfolio, you can get a far way or a long way into understanding how much you need to retire. And understanding how much you need to retire is crucial because so much of everything else in our financial lives is based upon that. How much do we save for college? How much do we budget for vacations? How much home can we afford? Well, these are all kind of like puzzle pieces in our financial lives as we're trying to balance that with saving for retirement. So when you get that piece right, it's easier to know how much can you allocate to other portions of your life, and it's crucial that you have that for a well-rounded financial plan. Now, as I mentioned before, The best way to approach this is through software. And the best way to approach this is with a professional who can help you get a very accurate prediction so that you know you're on the right track. If you're listening to this and realize, you know what, I really do want a financial professional to help with this, well, be sure to reach out to us here at Root Financial. You can see the link below to go right to our website. And if you're listening and saying, I think a financial advisor might be helpful, but I'm not yet sure I need one, well, be sure to check out this video, because in this video, I'm gonna walk you through when you need a financial advisor and when you don't, so that you can make the best decision for you. Once again, I'm James Knoll, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.